Hey, how's it going, guys? Welcome back to the Module 3 of Options Trading Foundation, the complete options trading course for beginners. Module 3 is all about the spread strategies in options trading. After we complete debit spread in the first two tutorials, now we will move on to the second half of this entire module, the credit spread. And in this sub-module 3.3, we will cover one of the most classic strategies in credit spread, the bull-put spread. Alright, let's get started. Before we jump into the details of the bull-put spread, let's take a quick recap of what is a credit spread. Basically, a credit spread is exactly the opposite to the debit spread. When you are taking a credit spread trade, you will be buying an option with a lower premium and selling an option with a higher premium. And that will create an instant credit for you into your trading account. And that is why it's called the credit spread. The two classic credit spread strategies are bull-put spread and the bear call spread. These are exactly what we'll be discussing for the rest of this module 3. Cool, now let's move on and see how the bull-put spread works. The best time to consider using a bull-put spread is when you see a stock is in a healthy uptrend but entering a potential consolidation phase. You believe the price is highly likely to go into trade in a range with strong short-term support and resistance levels, also with a potential upside move in the near future. Simply put, a bull-put spread can help traders to take advantage of the sideways range moves in the uptrending market. Why this matters? Because on average, no matter what markets you trade, they will only be trending 30% of the time, and the rest of the 70% will all be in ranges. Knowing how to profit from a ranging market is extremely crucial for an option trader. Also, a bull-put spread can help traders to take advantage of those moderate bullish moves in an uptrend without overpaying for the premiums. There are two trade legs to complete a bull-put spread trade. First, you buy one put option with a lower strike price. Then at the same time, you sell one put option on the same underlying stock with a higher strike price. For put options, the higher strike price is, the higher premium will be. So the premium you sell as a profit from your second trade will be higher than the premium you pay for your first trade. And that's exactly how you create this credit spread into your account. Here are some of the important details about the bull-put spread. All the options you trade are going to be put options only. No call options involved. Your short put is for income generation purposes, while your long put is for the downside protection. Both of your short put and long put should have exactly the same expiration date. Also, the number of puts you long and short must be exactly the same. The main goal of a bull-put spread is to let all the put options in both of your trade legs go expire worthless and you keep the premium as the profits. I will share with you guys more on this later in the case study. There are two main ways traders use a bull-put spread trade. First is for the short-term instant income generation. Traders often use those short-term out-of-the-money put options with less than 3-month expiration period to profit from those short-term neutral to bullish market actions in the consolidation phase. Second, some traders also use bull-put spread for long-term wealth accumulation. They use those really long-term deep in-the-money put options, usually those LEAPS options with more than 12-month expiration period, to profit from this long-term uptrend. Based on my own experience, I definitely find the first way to be way much more effective and more suitable for my style. Pretty much, I only use the bull-put spread for the short-term income generation purposes. Alright, now let's do a case study with a real example and see how the bull-put spread strategy can help you in your options trading. AT&T stock is currently traded at $27 per share in October 2020. After you did some technical analysis, you believe that AT&T will be trading in a range over the next 2 months, with a strong support level at $25 and a resistance at $28. You have been thinking about buying call options at the support level, but the premium of those call options at a $25 strike are very expensive because the volatility goes a lot higher at those key market structure levels. You want to take advantage of these potential range market actions, but also you want to minimize your potential maximum risk. So the best strategy for such situations is to use a bull-put spread, and this is how it works. First, you buy one AT&T December 2020 put option at a $22 strike. Currently, it's traded at 80 cents per contract. Then at the same time, you sell one AT&T December 2020 put option at a $25 strike. And now this put option is traded at $2.2 per contract. Because this $25 strike price is exactly at the support level, the premium will be much higher. So after you complete this trade, you will now have a net credit of $140 that goes into your account. This is the difference between those two options premiums. Your total maximum risk for this trade will be the difference between the higher strike price and the lower strike price multiplied by 100 and minus the net credit. So after the calculation, we can get that the total maximum risk will be $160. your maximum reward is equal to the net credit for this trade, which is $140. And finally, the break-even price will be the higher strike price minus the net credit divided by 100. So after the calculation, we can easily get the break-even price is $23.6. Alright, once we have all these key numbers, we can now draw the risk graph for this bull-pull spread trade. First, we have the lower strike at the 22 and the higher strike at the 25. Remember, the higher strike price is where the short-term support level is. Then we have the break-even price at the $23.6 between the higher strike and the lower strike. So what this risk graph can tell us is that when AT&T stock price stays above $23.6, your trade will be in profit. And if the stock price can hold the support level over the next 2 months, which is exactly what I expect from your technical analysis, then you will be able to keep that $140 at the beginning of this trade as the maximum profits. On the other hand, if the stock price moves below the break-even price, you will be in losses. If it breaks below the lower strike of $22 by the expiration date, your trade will hit the maximum loss, which is $160. Basically, your best case scenario for this trade is when AT&T stock stays above the key support level of $25 over the next 2 months, so both of your put options will expire worthless and then you keep the maximum profits of $140. And the worst case scenario is when the stock price breaks down and stays below $22 on the expiration date, and in that case, you will lose $160. So now you probably wonder, why am I risking $160 to only gain a potential profit of $140? Am I risking more to actually profit less? It doesn't sound like a good deal at all. That is because one of the key features you need to understand about all these credit spread trades is that although all these credit spread trades may not have a high reward to risk ratio, they do have pretty high win rates. And also, very importantly, they have very short expiration periods that works exactly in your favor. So that is why a solid foundation on technical analysis and using it to identify those key market structures is extremely crucial to trading credit spread. Now, I will share with you guys how to choose the proper strike prices for your bull-pull spread. First, your higher strike price should be at or near the support level of your underlying stock. Basically, this is the price where you believe the stock will not break to the downside in the near term. Second, your lower strike price works as a protection, so it should be calculated by your maximum risk per trade. This is the price that you use to decide your position size. Alright, one of the most common questions a lot of beginners have asked when it comes to trading the bull-pull spread is that if I already know the strong support level, why not just buy call options at the support level? It'll be much easier, right? Yes, it will be much easier, but unfortunately, buying call options at a key support level also has a higher risk. And let me show you why. If we compare this bull-pull spread trade and the buying call options at $25 strike with the premium at $3.2 per contract, we can see that the maximum risk for the bull-pull spread is only $160, while you will be risking $320 if you long call at this support. Your maximum reward for the bull-pull spread is capped at $140, and a long call trade can give you unlimited profits. But the bull-pull trade literally costs nothing because you will instantly generate credit income into your account in forms of the premium, while buying the call option will cost you $320 right after you execute that trade. And of course, the break-even price for the bull-pull spread is way much lower than directly buying a call option. That shows the probability of you making a profit from this trade is way much higher and much more reliable. So, as we can see from this comparison, a bull-pull spread is a way much better trade than directly buying a call option at the market support levels. Alright, here's the quick summary on the bull-pull spread. It works the best in a range consolidation of an uptrending market with a higher volatility environment. It is a credit spread strategy, which means you will have money instantly goes into your account first when you take that trade. Both of your risk and the reward will be limited. It is one of those typical trades that have a high probability win rates but with low reward to risk ratio. There's no cost for a bull-pull spread trade. Those out-of-the-money put options with less than 60 days expiration period are preferred in the bull-pull spread. Just a quick reminder for those complete beginners. When you trade credit spread, because most of the options you'll be trading are within 60 days, the rate of time decay will be accelerating really fast, and that will make it more challenging for you to managing your trade. So you might find it's easier to actually trade debit spread compared with credit spread as a beginner. This is completely normal. But it should not stop you from learning how to trade credit spread. I'm sure once you go through some practice, you will be able to trade credit spreads with full confidence. Alright, that will be the end of this tutorial on the bull-pull spread. In the next video, we will cover another extremely important credit spread strategy, the bear call spread. If you are new to this channel, my name is Vic. I hope you guys enjoying the course so far. If you find my contents have been valuable to you, please consider subscribing. Again, thanks so much for watching, guys, and I'll see you guys in the next one. Bye for now.